And thank you for spending the time. I'll introduce myself in 30 seconds. Asaf Ronen, as Eleanor said, spent some time in SoFi running product and growth and tech. Did the same for Payoneer. Before that, spent a few years in Amazon, one of the founders of Alexa. And these days, I'm helping companies from startups all the way to large companies accelerate growth, innovation, and help them with strategy. But what we're going to talk about today, and let me start presenting, is I think, Eleanor, I'm unable to share screen,
Give me 1 second.
is how to accelerate innovation in highly regulated environments, and more specifically in the fintech world. Um so let's see if we
You
can
should be
present.
able now.
We can
Yeah,
present. Now we can present.
sorry about that.
I'll move to present mode. So if you think about it, and I want to start with this picture of the Bugatti Bolide. I think that a lot of you, if you know something about Bugatti, a lot of you heard about the Bugatti Chiron, which is the fastest car that you can drive in the street. But the Bugatti Bolide is actually the fastest Bugatti because you drive it only on a racetrack. I'm not a race driver or anything else, but the reason I'm putting this picture here is that because the thing that they invested the most in when they built this very fast car, and when I'm saying fast, it does 0 to 60 in 2.1 seconds at top speed of 320 miles an hour. But the most complex thing to build there, and what enables all this speed, is actually the fact that it has the biggest brakes in the industry. It took them multiple years to build the carbon brakes on this car. And what I'm claiming here is that the fastest cars need the biggest brakes. So, in order to drive fast, in order to move your product in a fast way, you need to build the belts and suspenders, the brakes, the mechanisms, and to think ahead in order to enable that growth. And when we think about fintech, why fintech is more complicated? If we think about building software products, which was my, the first part of my career, you have product engineering and operations and marketing. If you manufacture something, you have manufacturing, and this is how you move fast. There are very few teams across the company that you need to integrate with or to coordinate with and integrate the requirements, and you can move in a fast way. Regulations a little bit not as much. But when you think about financial products, there are a lot more players and things to consider when you think about building them. You have financial operations, you move money. There are teams that all they do in their life is move that money. You have layers on layers of compliance. Then you need to think about credit boxes. Do I want to offer a loan or not? Liquidity. How much money do I actually have? And of course, when it comes to money, a lot of risk and fraud, and people are trying to steal, etc. So the complexity in thinking about features, designing those features, shipping those features, and measuring those features is a lot higher. So how to design a product ready for that regulation? And the focus is first on changing regulation. Because unlike a lot of other areas, regulation is something that a politician or anybody can change just because they want to or they think that they need to. So how do we design a product and not chase regulatory changes all the time? So in order to start with that, my claim here is start from customer centricity. Basically, what I'm saying is that customer centricity in many cases is larger or bigger than regulation. And why do I say that? Most of regulation was created to protect the customers. We all know none of us loves our banks. They always are there to prioritize their P&L over our best interest. How many times in your life, think about it, somebody came to you and said, hey, you have to try my bank, they're amazing. They're here for me to get rich, they're here for me to be better. That never happens. So financial regulation most of the time was created in order to help protect customers, put customers' interests first. So in that world, When you think about building features, think about the thank you bar. The thank you bar is say, for every message, for everything I do for the customer, imagine that customer and ask yourself if they say thank you. 9 out of 10 times, if they will say thank you to you, then you've met a lot of the regulation. You didn't meet all the regulation in the world because financial regulation has also other aspects, but 80 or 90% of the regulation equals the thank you bar. The second part, which I believe is super important, is understanding the why. Why is there a specific regulation? And why is this important? So, a lot of the times when we speak to people that their profession is regulation, they will tell us not why, but what. What do they need us to do? Limit money movement to $5,000. You have to write A, B, and C. And that limits our flexibility to actually think about a feature in a holistic way. So peeling the onion and understanding why was this regulation created, helps us when we think about what we build to solve not only the specific rule that exists today, but what is really needed. The second thing, beyond just understanding that, is really building a product that can be programmable. Why is that? Think about the fact that even if we start only from the US, every state has different rules. Every city has different tax rules. So we need to assume that we can't have just one logic that helps everyone. Rules are different between countries, between states, between cities, even between types of customers. Think about it, even, it's obvious that rules are different between state A and state B, but even if you think about investing money, accredited investors and non-accredited investors can do different things. Tomorrow morning, somebody can decide that you can become an accredited investor in a new way. So we need to assume that we're going to have multiple rule sets and multiple flows running at the same time. So what's going to be the approach of doing that? Separate your core from your logic. Consider using a layer, whether it's a layer of models, a rule engine, a decision engine, so you know up front that you can support all those changes. Because what you don't want is a spaghetti of a code base that you start adding code for every new regulation, every new territory, etc. And design this with experimentation in mind. Because if you think about it, now you have multiple dimensions. You have what you're trying to do, your business logic, your regulation, which is local, and then you need to add experimentation. So when you build that layer that has that logic, that manages the business logic, you need to think about experimentations from day one. And I'll give you a couple of examples of things that we've done before. So when I joined SoFi, we had a lot of code-based rules in order to underwrite loans. And SoFi at that time didn't have a national bank license, so every state has different rules, different limits to your interest rates, different things that you need to collect, different rules of who you're allowed or not allowed to give loans to. So we ended up first building a layer of a logic, both logic of underwriting, who do we give loans to or not, and then logic and pricing of what's the price that you're going to give that customer. Because even in pricing, regulation can interfere. The rules of what is the allowed interest rate or not. We spent a lot of time separating the data pipes, what data we use, from the actual rules so we can run them in parallel. And we built it in a way that we can run up to 10 different underwriting rule bases in every state. And if you design that up front, then we were able to move very fast and run hundreds of experiments of what's the right pricing. And as some of you know, in lending, prices are dynamic and are always in optimization between how much can I charge for a loan and what will get me the most amount of loans, because what you're trying to optimize for is maximal amount of profit here. In Payoneer, which is a different company, not as known, Payoneer is an international payments company, and it supports 200 countries. And in that world, when you think about onboarding, when I joined Payoneer, onboarding was many manual. And we had about 1 million new people starting to onboard every month, which is crazy. We had to build a code base to do onboarding for all of those. And they were not only individuals, but businesses, etc. When you think about how to build that, you build that in a way that you know that every country will have a different regulation of what you need to collect. But not only that, you build plugins because not all, you need to use different software companies to do your KYC or identity verification in different countries. There's no single supplier of identity verification that supports 200 countries. The last part is simplicity, because what I just described in the last 2 slides is how to make it complex. But we should always think about how we simplify how we think about the product. I always say to my teams is that simplification is the highest level of innovation. Always think about how can you simplify, because the regulation will add complexity anyway. Fewer rules, fewer exceptions. And I think that the word exception is something that we need to think and remember as something that we try not to do. Many times companies think about, hey, let's build an exception and that will make us customer centric. We'll do a rule, but then all the people that are 7 foot and above and can sing are an exception. The less exceptions you have, the simpler your code base. Focus on the happy path, even if it means that 1 or 2 or 3% of your edge cases are not going to be supported. And God forbid, you're going to say no to them. But that will simplify and accelerate how you move forward so you'll serve more customers. An example here was in Payoneer, as we were an international payments company and the Ukraine war started, it was obvious that we need to stop working with Russian companies and Russian individuals. And Payoneer was not a company that did a great job in simplifying. So the first meeting, people came with a long matrix of rules on how you identify who are the people that we should block, who are the people that we should not block. And we almost went ahead and did that. But that would have added tens and hundreds of rules that we needed then to QA and backwards verify every time. And at the end of that meeting, one of the folks said, but why don't we just say, hey, if the company address is in Russia, that's all. And yes, there might be some, edge cases, but just one rule, one simple thing. And we ended up doing that. That got us to deliver that change within the same day, not within a couple of weeks. But also, it accelerated our movement and our velocity going forward because we needed to test all the other rules. But when you design and build your features and your systems, you need to also think about data keeping auditability and explainability. What do I mean by that? As a financial company, and a fintech as a financial company, is as you grow, you need to understand that there's going to be a day when you're going to need to defend an onboarding, a payment, credit, any decision that you've made to a regulator. So you need to build the data trail to be able to defend it and defend it in a good way. So first, keep your data. Keep the data that drove you to make a decision of onboarding, yes or no, a lending decision, a credit decision, a rate decision. Keep that data. Not only the data, keep revision of the rules and the data that was used. This is important because many times people think, okay, I have the data, I have my rule set, then I'm good. But that's not always the case, because when we accelerate velocity, when we experiment, different customers were treated with different rule sets. And we will need to say, okay, Asaf was declined for $1 billion of a loan because he doesn't have enough money. But seriously, this is the rule set that was used for Asaf. So it's important to keep not only the data but the revisions of data, because we're going to add data over time, and revisions of rules. Um, think how an audit would run. So when you build your data structures, when you save that, prep for an audit upfront. And when you do that, you're not going to have fire drills when a compliance team calls you and say, "Hey, I need you to get me all the data for X and Y." So that will allow you to move forward and focus. The last thing is invest in model explainability, because in 90% of the cases, decisions are going to be made by machine learning models. But we need to understand that models need to be able to back up and explain why decision A was made versus decision B. Because most of the times the regulators won't care that the model made the decision. They'll ask why. But not only regulators. I'm going to give you an example from my time in Amazon when I built Amazon's Choice. Amazon's Choice is the recommendation system that tells you when you're looking for, glass of water, what is the one that's recommended for you. And one of the things that we saw that customers asked is, why do you recommend A versus B? So we had to build a way for them to double click and say, this is Amazon's Choice, or today it's Amazon recommendation because of A, B, and C. So think about explainability when you build your system. Next part, let's talk a little bit about technology-driven compliance. A lot of the financial institutions and financial systems were built in a way that assumed many humans. Think of Bank of America or Citibank. How many thousands of people are there to do manual work? But as companies that want to move fast, we need to think about it differently. And we have a lot of logic that in old school fintech needed people, anti-money laundering and monitoring and underwriting and KYC, as we said. So we need to think how to use technology to do that fast, efficiently, and be able to run an experiment. So first, assume when you build something hands-free, no humans. Many times we think, okay, we're going to have, we're going to cover 50% of the cases, 60, 70, 80. Start from the opposite thing. What we've done in many cases is to say, we don't have any humans. So if we support only 80% in our MVP, it means that for 20%, we just say no, which is okay. And then we're going to have a KPI of moving from 80 to 90 to 95. As I said, build rules and use, machine learning. The more models you have inside, the better you'll be able to do that automatically. And the way that I've used machine learning models in a world that you want to accelerate and you don't want to couple the work of your data scientists and the work of your engineers is to build software in a way that your MVP doesn't have a model. It have a very simple rule set of 1, 2, 3, 4 rules, but it's built in a way that when the model exists, you plug it in instead of the rule based. And then you build your build chain in a way that you can iterate on the model without changing the code. The third thing to do here, and this is very hard. I spent started as 20 years as an engineer an engineering manager in my career in Microsoft and Amazon and other places. And in those companies, we invented the NIH, not invented here. So we wanted to write software for anything. And that is maybe good for a very large technology company. But when you're a fintech and you try to move fast, this is not what you need to do. You need to identify your magic dust or secret sauce, but then think in anything else, how can I integrate other products? What I've learned, and I've learned the hard way because my first year in SoFi was different. I came from Amazon, and I think that we need to write all the code in the world, is that in 8 out of 10 cases, the thing that you need to build exists as a company that provides services, and you can just integrate it. Why is this important? It's important because I always use the Amazon term of innovate on behalf of the customer. So if I can bring in a rules engine, an ID verification, knowledge base, whatever that exists from the outside, I've given my customers service faster, and that's important. Add as many data sources. The more data sources you have, the better the decisioning that you'll have. Declining is better than sending to humans. Again, this is counterintuitive to many companies, but it's okay to say no if you don't have enough data or enough information, and then increase the yes over time, but don't assume exceptions and people, etc. And just keep it simple. So how do you do that in a company that has people from compliance and treasury and ops and regulation? How do you do that? Some examples and some stories that helped me at least. So compliance in many cases, and a lot of people here are marketeers, will say, I need to check every ad and every message you send to customers. That means that when you're experimenting, when you're changing your ads, when you're trying to see what's working, you need compliance in the loop. A way to go around it in many cases is build a word, sentence, offering, and image banks that allows you to do Lego work and experiment within those boundaries. So what you require from the compliance folks is to increase what's in the bank and for you to have now a bank of things that you can use instead of them being in the loop for every language change and email title experimentation when you have 10 different things you're trying to see what's working. That is going to be harder. And usually the more that we can use, and today we're using tools and machine learning to create hundreds of those, it's going to be very hard to do that and keep compliance as fast as you want to. So use them and build a bank of information you can use. Treasury. Treasury is hard because when we talk about money, their job is to keep the money. And in many cases, when you experiment and you're trying to run fast, you might need a little bit of money to play with. So the one thing that I've learned works best is, define your boundaries up front. Define how much you're willing to lose. Define how much is okay. You do the same with the business itself. Introduce the word breakage. And we'll talk about that in an example for referrals, but you're always breakage. You're always errors when you invite people, when you pay people money. But it's okay to have breakage of 5 or 10% as long as you agree on this upfront. So let's talk about an example from SoFi building rewards and promotions. And we had to bridge two very different approaches. We had a few folks that came from Citibank of Bank of America, and we had a lot of folks that were product managers, marketeers from the Bay Area that worked in software companies. And the thing that we needed to bridge is the fact that breakage is not fraud. What do I mean by that? You build a world where you want to reward people for referrals, for example. And 95% of those referrals work great. And there are 5% of the people that get away with earning that money and don't get us a lot of value. A lot of people that came from the banking industry will say, hey, this is fraud, stop that. And I would say 5% breakage, just bake it into your business model and run fast and get and harvest the 95%. So upfront, discussing the differences between breakage and fraud is very important. And because if you don't do that, it's very easy to throw the baby with the bathwater. The second thing is plan for abuse. What I've learned is when you give people money, they'll be hyper creative in ways to get that money without giving you the value. So think about the edge cases and plan for people to try to do that. But don't mix that with, hey, this is fraud. I'm getting to the last parts, and how do you manage those internal stakeholders when you want to move fast? And what I've learned in SoFi and then in Pioneer is building mechanisms and being predictable in how you ship software helps. So for large features, do a kickoff with all functions. We've done this and it helped tremendously because that helped my PMs and my product marketing folks understand the regulation compliance and everything, the big questions that exist up front. And also, when you release large things, do that with all those functions. So compliance and fraud and risk will be comfortable. The way to make a lot of them comfortable is to have agreed upon metrics up front and measure them and have them published so they'll feel comfortable. The other thing, which sounds very naive and basic, but I've learned that it works and it helps, is really celebrate with the other functions. So when a feature is successful, when something has shipped, yes, the engineering team built it, the product team defined it and worked on it with customers, and product marketing marketed it to customers and got them to fall in love with this. But this is actually the time to bring in all the additional functions. So they feel that they're not only the brakes, but they're part of that car. Last thing, which again, it's an Amazonian term, but it helped me a lot, was differentiate between one-way doors and two-way doors. Most of the things that we do are two-way doors, are things that we can run an experiment, and if it doesn't work, it doesn't work. Very few of them are one-way doors. So if we make a decision or ship something, there's no way back. There's a very different process for two-way doors versus one-way door. Think about it, define whether you're going through a two-way door or a one-way door, and then build a process around it. So hopefully I gave you a little bit of taste, and I'm no longer in SoFi, but I want to talk a little bit about how it worked for us in SoFi. So in SoFi, when I started together with Anthony Noto, we inherited a company that didn't move fast and was a great company, but focused only on student loan refi. And we needed very quickly, and we said that we're going to build the best consumer bank in the world. So within 18 months, we were able, with the learnings that you have here on the deck, to ship SoFi Money and SoFi Invest and an AI-based advisory called Relay, and a financial feed and home loans and student loans and personal loans and credit cards with not a very, very large team. We did that because we used all the lessons learned here and focused on the customer. And so many times doing that, it helped us be able to move fast. So that's the story. I'm going to stop sharing here and move to questions, to Q&A. And I'm going to use the ones with most upvotes. So I'm going to read them out loud, try to answer. If I don't understand the question, I apologize up front. The first question, how do you keep it simple and focus on the happy path, which probably will ignore 30% of customers and stay customer-centric at the same time? This is the biggest dilemma. I believe that you start with the happy path. Yes, you're saying no to some customers, and if it's important, you'll be able to grow the happy path over time. But focusing on the happy path allows you to stay out of magic, allows you to move fast, and by that provide more value to more people. I think that many people are making the mistake of thinking, okay, no customer left behind equals customer centric. I think that customer centric means you're able to take a customer segment and delight them and make them so happy that they'll call their friends and say, hey, you have to try this feature. You have to try this company. Even if it means it's not for everyone. Now, over time, if from a business perspective, you're saying 70% is not enough, then you need to think about how to grow that. And that's okay, but the mainstream should be focus on the customers that you love, do an amazing job with them, and over time grow the 70 to 80 or to 90. That at least was always my playbook, and that allowed us to move fast. And then if we see that from a business perspective, and you hear say ignoring 30% is not good, if from business perspective it impacts you, then you decide to grow the rule set. But don't assume that serving only 70%, which is a segment, is not customer centric. Have them fall in love with you. That is being customer centric. Um, and I know that in a lot of cases, this is fairly controversial, and it's a cultural thing. But is customer centricity giving an average service to everyone? Or being customer centric is starting with giving an amazing service to most of the customers and being upfront with the rest and saying, hey, I'm sorry, I'm not ready for you. Next question. Can you dive deeper into the thank you bar? The thank you bar is a made up bar that I made a bunch of years ago and I fell in love with this. And it started from notifications. So 7, 8 years ago, all financial institutions starting to send notifications about credit card swipe, etc. And we built a set of rules of when to send a notification, etc. But when we started distributing the decision to many teams, and when we scaled as a team, there wasn't one or two people that were able to say, hey, this is something that we want to send a notification for, and this is just spam. And all of us, if you open your phone, you have tons of messages and emails. If you look at them and you say, damn it, this is spam. Most of the time, just throw them to spam folder. And the thank you bar is, imagine you receive a message. If silently you say, hey, thank you for sending me that message, it was helpful, that met the thank you bar. If you're saying, I'm not sure it helps me, I know it helps them, they want to sell more, then it didn't meet the thank you bar. Even when you cross sell, it needs to help. And I'll give you an example here. So in SoFi, a lot of the revenue came from cross-selling customers that came for checking and savings to loans. There are two types of ways to sell a loan. There's the one, if you open your mailbox today, you'll probably have 20 envelopes saying, hey, you can qualify for $1 billion of a loan, just apply here. You might or might not get it. To me, that is spam. What we did in SoFi, we called it internally Magmo, is to say, hey, Asaf, we have your information. You're paying $1,000 a month on your personal loan. We've done the work. We will approve you the same loan and you'll pay only $900 a month. Press here to reduce your payment by $100 and we will do the work. That is something that meets a thank you bar. Because that customer say, oh, damn it, I can save $100. It's not I might be able to save $100. I will save. And we honor that. The customer clicked, it was 5 clicks, and they got a refi of a loan. But in their mind, they reduced their payments. And we sent it only if we knew that we can do that job. So that is the thank you bar. Hopefully that example helped a little bit in that explanation. Next question. How do you integrate your compliance and legal teams into the innovation process? Typically, they're quite scared to take any kind of risk, even if you can make the case that the customer centricity equals regulation. So there are two things, and yes, these are very, very different cultures. A lot of the compliance and risk people are people that grew up in a risk-averse environment. And by definition, innovating is taking a little bit of risk. So there's an inherent tension here. But what worked for me is multiple things. First, bring them in early. Bring them in early so they feel part of the team. If they feel part of the team, it helps. adopt a language of yes and not a no. So as a company, and we worked on that in SoFi, and then I adopted that in Payoneer and other places, is as a company, we said we never say no. We say yes, and this is what you need to do. And you need to work on that with your compliance and regulatory teams, because it's very easy to say no. Force them or help them say, hey, the answer is yes if you do this. So now they're enabling you to do something. So I think that these are important. And then the last one is going back to what I said about understanding the why. If you understand why there is a regulation, you can speak to your compliance and regulatory teams and solve for the why and not for what they've seen Bank of America do in order to solve that why. Now, it doesn't mean that everything is never going to be without tension, but when you use those things, it helps. Bring them in first, measure the things that they care about, understand the why, it always helps. Okay, next one. How and where do you keep a clean documentation of your decisions, etc.? So I'm assuming here that you're talking not about the management decision that sit in a room and decide to build feature A or feature B. That one is easy. If you're highly regulated, and I had the privilege and a lot of scars from being regulated by the Fed, making big decisions, you write them down, you save them. But when you think about underwriting and KYC decisions, those decisions are just data. That data need to be saved as in the version of the rule set or the model that you used, and what is the underlying data that you used to do that. If you think about saving that data per transaction, per decision, then you have another data in your data lake or wherever you save it. And when somebody wants to open the hood and check, they can do that. Whether it's because you want to do that to audit yourself, somebody else wants to audit you, or you have a customer that should have received a loan and you said no to, and you want to go back and understand why. So, meeting type decision, just write it down, save it somewhere in a repository. But rule based, things that are in software, just build your software in a way that there is a data entry for each and every one of them that includes the rule based version. Every time that you change the rules, save that so there's versioning and every record can point to those versions. Uh, okay. Nicola, who was asking the question, I was referring to the concepts architecture diagrams. Do you use specific tool for this or just any documentation tool? I am honestly, I've been with many documentation tools, etc. I'm not the expert to tell you, hey, keep it here or there. There are many tools that keep versions of documents. You know, in SoFi, we were big on Google Docs. It was good enough for us. Then we used other tools, but to me, I'm always talking about the logic, and that would be my logic. So sorry, Nicola, that I wasn't more helpful. Um, Next one. What? Sorry. What kind of personality traits do you look for in a PM who thrives in a regulated environment relative to consumer tech? That is a great question because I can tell you that the first generation of product leaders I hired for SoFi failed miserably, and we then hired the second generation. And I think that it's not about different traits; it's about whether that trait is a superpower or something you also have. So to me, the big things about every product leader, it needs to be able to think big and have bias for action and dive deep and all of those things. But when it comes to fintech, I saw that you have to have a superpower in earning trust and being collaborative. There are amazing product leaders that are just trailblazers and break every wall in the world, and collaboration is not their superpower. But in a software company, the fact that they work well with their engineering team is good enough and it's okay. I've learned that in a fintech environment is harder. So we really double down on ones that can be collaborative, can talk in multiple ways, and dumbify the message to people that are not tech people. Um, and as soon as we started doing that, actually it accelerated us. So as soon as we've learned that we have to have those type of traits, that helped a lot. So the lone wolves of the world, etc., are great. I wouldn't bring them into this environment because you need buy-in, and buy-in is important. Um, and I think that the last one that I'm going to take, I think that we're hitting time here, is please provide examples. How have you integrated AI-based rules? So at the end of the day, you want to build a model. You want to build a model, and that model is a learning model for every decision that you want to make. The good thing is that most of the decision engines that exist today, decision engine is a fancy word for outside tools, third party tools that are logic layers. They know how to integrate ML models instead of rule based. And all that you do is you have the team that builds the model and experiment them, and you integrate them into your decision engine and use that. The other thing is really think about, don't wait for the model. You can start with simple rule set and then add the models and experiment with them. I think that we're at time. So first, I wanted to thank everybody that has been here. I know that there are more questions, etc. You're more than welcome to reach out to me. What I do now is help company break those barriers and work on the strategy, etc. But even if you don't need that, if you just have a question, I'm always happy to help. So have a great day, and hopefully this helped you a little bit. Thank you.